Hey, it's Matthew Decker here at Leveraged Wealth Management. I hope that you're doing well today. We travel around the Atlanta metro area and give financial planning workshops. And one of the topics that comes up all the time is future tax rates. And it's one of the reasons that we advocate really hard for things like Roth conversions, fully funding a Roth 401k if you have one through your employer. And then we also look at index universal life insurance as a third option for tax-free income later on in retirement. And this topic came up the other day about the government and what they're going to do with future tax rates. And we made the point that we think taxes could as much as double in the next 10, 15, 20, 30 years. And that's backed up by a lot of people that have said similar things, like the CBO, Congressional Budget Office. They made that point a couple years ago in a letter to Congress. The former comptroller David Walker has made that point. He served under both Bush and Clinton, and he has said basically taxes should double in order to account for our future unfunded liabilities. And I just want to show you one quick, easy example how taxes have maybe already doubled for you. You just don't know it yet. So we're going to head on over to the whiteboard, and I'm going to explain one way that the government has essentially doubled taxes for people overnight and no one is talking about it. So let's head over to the whiteboard and get this thing started. So you may be thinking, double the taxes, well, how is that possible when the tax rates are the same? So we have the same tax rates, and yet we have clients that are paying twice as much in taxes as they would have 5 years ago, 6 years ago, 7 years ago, right now due to regulatory changes that took place a couple years ago. So what I'm actually talking about is the Secure Act. See, the Secure Act did something that a lot of people have missed, and that is that it has eliminated the stretch IRA. So it used to be that if you inherited an IRA from a non-spouse, you could stretch out the payments from that IRA over your lifetime. And what that did is it reduced the tax liability of that inherited IRA. An inherited IRA is similar to withdrawing from an inherited IRA, is similar to earning income in some ways. The IRS sees that as ordinary income. They tax it at ordinary income rates. And so it's very beneficial, or it used to be very beneficial, for you to be able to stretch out those IRA payments if you didn't need it over your entire lifetime because it reduced your tax liability. So we have several clients that recently have inherited big IRAs. And so I'm just going to give you one example of a client that we worked with about 2 weeks ago, and I'll just explain their situation. So they were in their early 60s. And they inherited an IRA that had $1 million in it. So it had $1 million inside the IRA. They inherited that $1 million through the IRA contract. Now they were currently spending $100,000 per year. And so, that comes with all the taxes associated with $100,000 per year. And that was all pretty much ordinary income and retirement withdrawals. So here's what's crazy. They're spending $100,000 per year. They inherited this IRA with $1 million balance in it. And what the Secure Act did is they essentially said that you need to take that IRA and you need to split it up into 10 payments at a minimum. And so you have to spend this inherited IRA within 10 years. So 10 payments out of this IRA is what they need to distribute, and it doesn't take much to do the math on that IRA balance split up over 10 years. They're essentially going to have to recognize an additional $100,000 of income from the IRA over the next 10 years. And what has just happened? Well, they were already spending $100,000, making $100,000 a year, and now they're forced to draw down this IRA at $100,000 over the next 10 years. So for the next 10 years, their taxes have actually more than doubled. They're paying twice as many taxes as they would have otherwise because the government has come in and they've taken away the stretch IRA and they've said you need to liquidate this IRA contract within 10 years. So this is just one reason why we advocate strongly for tax planning, forward-looking tax planning. So this isn't looking at last year and what you paid in taxes and doing some things to get your tax bill lower last year. This is forward-looking tax planning, where you need to have an eye on what the government is doing, and they have a problem to solve. And that problem that they have to solve is $160 trillion of future unfunded liabilities, mainly made up of Medicare, Social Security, Medicaid, future spending on pensions for government employees, and interest on our debt. So that future unfunded liability number is so large that the government only has two ways to fix the problem. They can either spend less or they can tax more. Well, spending less from a math standpoint actually doesn't solve that problem, because they have so much debt and yet they collect so little and already spend so much more than they collect. The only way that the government solves this problem is by taxing more. And that Secure Act change is one way that the government can double your taxes overnight without affecting the tax brackets. So our advice would be that you absolutely need a plan. The government has a plan for your money. And the government's plan for your money is to get more and more and more of it, because they have a problem that they have to solve. The only way to avoid the government's plan for your money is to make a plan for your money and to know where it's going, how it's going to be taxed, and protecting yourself from future tax increases, whether that's income tax bracket increases, whether that's things like eliminating the stretch IRA that we just talked about, whether that's future surcharges on Medicare premiums. All these are different ways that the government can increase taxes. And so if you haven't made a plan for your money, now is the time to make a plan for your money. Make sure that you have the right amount of money in the right buckets, both from a risk standpoint and from a tax standpoint, because the only person that's going to get you in the right position to make sure that you don't fall into the government's plan for your money is you. So if you'd like help with that, we can certainly help. You can go to our website, leveragewm.com/contact us. I'll link that in the description below. We'd love to have a conversation with you about planning for your money, making sure that it's in the right place so that you don't pay any more taxes than you have to. Let us know if you have any questions or comments down below. If you haven't already done so, subscribe to this channel, like this video, share it with your friends. We are solely focused on making sure that people have a plan for their money. It's a forward-looking plan that deals with things like risk, with taxes, regulatory environments, and so if you haven't already made a plan for your money, now is the time. This is Matt Decker, Leverage Wealth Management. We'll talk to you next time.